grand opening. I think it's going to be in January. So the people that I'm going to invite are the realtors that are typically in our Monday Mortgage Minutes consistently. So be on the lookout for the invite to our opening to our new office so that you guys can stop by. Oh, there it is. So that you guys can stop by. Just record on this computer. Yeah, so you guys can stop by and hang out for a bit. I'm pretty sure we're gonna have drinks and stuff like that. I know that we didn't do Monday Mortgage Minute last week, so hope you all had a great Thanksgiving with family. Took some time to kind of decompress. This year has been crazy. I did not take time to decompress because I thought I was 21. And so I played football and I messed up my Achilles and I may need surgery. So we'll see. I guess I got to see the doctor this week and kind of come up with what's going to happen. But yeah, tore my, oh, that's not confirmed yet, but pretty sure I tore my Achilles tendon playing football Thanksgiving Day. So I spent most of my day in the hospital, but still fun. The greatest part of it is that we were moving last week. Yeah, last week. And I didn't have to help do anything. Everybody did it for me. So it was pretty cool. It's the only positive. Also, I did join the board for NAREB. You guys know me. You guys know how much I care about home ownership. So I'm excited to be part of the board. We had a meeting last week as well. I think it was in the beginning of last week. And kind of excited for 2023. There's a lot of good things that the president, Ms. Hickman, is going to be or looking to do for this year. And I don't want to say anything because I don't know if I can, but we do have a general membership meeting this week. So if you are a NAREB member, it's on Zoom from 12 to 1, typically lunchtime. So if you're a member, just hop in that call because you may get some good information. We're kind of figuring out how we can continue to help the community through different avenues. So you definitely don't want to miss that. And then, of course, they're going to be introducing us as well, the new board members. So it's me. It's Mark Williams with PRMG. It is Yasmin Bazumber and Tiffany Washington. So 2 realtors, 2 lenders. And yeah, I'm excited. I'm excited for this year. And we'll see what we can do. I am giving away. So we have a gala. If you're a member and you're on this call, after this call, email me today because I'm getting 5 tickets, technically 1 for myself. I'm going to invite 4 of you guys. So the 4 people that email me first after this call, not before, not during, after we hang up here, I'm going to give your gala ticket for free so you can come out. It's next Wednesday. And that's going to be fun as well. So if you're a member, if you're a NAREB member and you want to go to the gala, I'm giving away 4 free tickets. Okay. So now let's jump into Monday Mortgage Minute. So a lot of stuff happened last week. The week before was Thanksgiving, so it was a relatively slow week. But we got personal consumption expenditure, PCE, which we know that this is the Fed's favored measure of inflation. It came in at 0.3% month over month positive. But we already know how that formula works. Year over year, it has actually come down from 6.3 to 6%. So that's because last year's month over month was 0.6. But the good thing is that Fed Chairman Jerome Powell actually came out. He did it the night before PCE came out, and they're pretty sure that he knew what it was going to come out at because he basically said, he believes that it's time to stop or slow down the rate hikes. And they may do it as early as their December meeting, which is on the 14th. So that is really, really good news for the markets because remember the number of the Fed funds rate, whether that be 4, 4.5, whatever that is, doesn't necessarily correlate with what the mortgage rates are. But the volatility that happens from continuing to increase it so drastically is what has been hurting us. So for them to basically admit that they're going to stop muddying the waters, it's really, really good news, as well as inflation coming down, which we're going to talk about a little bit, how that's really affected rates in real time in a bit. Pending home sales fell another 4.6% from September to October. and they're down 37% from this time last year. This is basically just signed contracts on existing homes, and even though we're negative, this really isn't a surprise. So that number is pretty big, 37% on pending home sales, or negative 37% on pending home sales is pretty big. But with everything that's happened this year, with lower rates, with higher rates, with the volatility in the market and things like that, people are just scared. So it doesn't really surprise me that we're so negative in terms of home sale pending contracts, basically. Home price appreciation is in for September through that Case-Shiller home price index, which we know is kind of like the gold standard. Shows home price appreciation went down another 1% month over month, which is pretty big, because I think the previous ones we've been at a little bit less than that. I don't think we've been at 1%, but we're now at 10.6% year over year home price appreciation. Miami is still first place, which when they're talking about Miami, they're talking about South Florida in general. Still in first place at 24%, 24.6% year over year. So home prices are really not going to come down that much. Because remember, the average is 3 to 5%, but we're talking about on a national level. We're not talking about on a local level. So with that number being at 10% and we're still at 24.6, by the time that number reaches that 3 to 5, which I think by this time is probably going to be by the end of the year, Miami or South Florida is still going to be in the teens, maybe 13, 14%, give or take, is my assumption. Originally, I thought we were going to end the year at about 8 to 10%, 10% on the high end. I think it was going to be around 8 to 10%. I'm starting to think that number is going to be closer to about 5 to 6, because if we're already at 10% and that's September's reading, we still have the last quarter, October, November, December, for that Case-Shiller home price index. So we'll see kind of where we kind of land with that at the end of the year. Jobless claims, the numbers are rising consistently now. Now we're kind of seeing that pattern. We've been talking about jobless claims, I think, since like July, August, I believe, and we've been just trying to wait to see that trend of it consistently increasing, right? Because unemployment is a big factor to not only recession, but also to kind of show us more or less, like, it helps rates. Unfortunately, it just does. Job losses require people or investors to invest in the bond market, and bonds are good for rates. So we saw that in the week of Thanksgiving, which was a short week, 225,000 initial jobless claims or initial claims were made, but continuing claims are up to 1.6 million. We were at 1.5 for the past 3 months, I believe. So we're at 1.6 million, and pretty much continuing claims are people that are still receiving unemployment benefits. Initial jobless claims, those are the people that have just applied for it for the first time. So 225 initial jobless claims. We're at 1.6 million for continuing claims. That number, I believe, is going to continue to rise from there. Now we're going to talk about some rates. I don't know if you guys received the email that I sent last week, because for some reason, none of my systems are working for me. But if you did receive that email, I basically told you guys that we're reaching out to the pre-approvals that we have with you all, and we're letting them know that rates right now are steadily coming down. And if they were pre-approved before earlier this year, there's a chance that they can get a higher pre-approval because rates are coming down. But most importantly, it's really the best time for them to start shopping, because if you wait for everybody else to tell you that rates have come down, everybody else is going to jump in at the same time. And so we're going to see our clients fighting once again against 7, 8, 9 offers for people that have been on the sidelines waiting this whole year. And then on top of that, since we already know, since we're going to be getting in there up front before people are actually realizing that rates are dropping, you're still going to be able to get concessions as a buyer. It's going to be a net positive for them. I know that I told you guys my original estimate was being in the 5s mid to late 2023. I was thinking June, July-ish. I think that time is much closer from what we're seeing. Rates right now on average, they're at about 6.5%. And I'm going to show you guys my screen because I'm actually excited for what I see. On average, they're at about 6.5% right now. So being in the 5s is not too far off, because technically once you're at 5.875, you're technically in the 5s. And once people start to hear that 5 number, they're going to just react to it, right? the biggest thing that I'm actually happy about is premium. Okay, so let me share my screen here. Remember, we talk about this today. We're not having a great day, but that's fine. We've had a lot of consistent growth, so it calls for one bad day. But remember, I talk about when we're looking at these bonds, you want to make sure that you see anything above 100, because 100 is par. That means that basically, if this was at 100.00, that means that Wall Street is not giving you anything, nor accepting it, or nor accepting anything from you for a 5.5% interest rate. Now, if it's above, right, 1.14, that means that Wall Street's giving 1.14% for that rate. And so what happened most of this year, because I haven't seen premium since like March or April, is that this has always been at 99, 98, 97, these numbers. And that means that that cost gets passed down to the client, because that means that Wall Street does not like rates at that price point. And so in order for a client to get an actual interest rate, they have to pay out of pocket for that. So to not have to see that we're getting some premium, even on that 5% coupon, we're almost at 100. But most importantly, for the most part, so you guys know this, a lot of lenders, they're going to go off of the 6% coupon. It's just giving the most premium right now at 2.27. That means that for 6%, that Wall Street's giving 2.2% of whatever that loan is for that rate. Doesn't mean that rates are exactly at 6%, because there's costs that go to the lender throughout that, right? There's loan officer costs, processing costs, like basically just operations costs in general. There's also the fees that go to Fannie Mae, which is usually 75 basis points or 0.75%, as well as 0.25% for servicing usually, things like that. So ultimately, you would probably see rates at about, without paying points, 7%, 6.75, 7% without paying points. Doesn't mean that that's the rate that people are really seeing right now. There are some people that are still putting points, because 1% may get them from a 7% all the way up to about a 6.5, a 6.4, and that ends up being worth it for the client at that time, because 1% may be on a $300,000 loan, it's going to be $3,000, but they're going to save about 150, 200 bucks a month. So the good thing is that now it's not like, hey, these clients have to pay points. No, they may not. And so if they're tight on cash to close, we're going to be able to help them with that. If they do want to pay points, they are going to get much lower rates. But I'm excited to see that there's premium here, because it just means that that's a good sign for mortgages or for interest rates kind of moving forward. And it kind of also gives you another glimpse of, okay, that this is a real possibility that rates are going to come down from here. Because as these premiums continue to go up, you start moving away from these coupons, because 6% is at 102, 5.5 is at 101, 5% is at 99. But once these rates continue, or once these bonds continue to go up, right, that means that this at one point is going to get to 102. And then once this goes to 102, this will be at 101. And that means that now lenders are going to be starting to price at 5.5. So instead of a 7% interest rate, now you're going to see people at 6.5 without paying points. And then we're going to continue to go down from there. That's how those bonds work. So it's good news, because we're cutting costs now for clients already up front, if they're doing a standard FHA conventional VA. But also, nothing has changed in terms of the buy down options too. So now where they're getting a 6.5, where before it was like a 7.5, and then we're kind of trying to pitch to them that they're going to get a 5.5 for the first year. It's kind of still going to be the same thing, where now they're getting a 6.5, but they're going to be at 4.5% for the first year, and then 5.5 for the second, and then 6.5 for the third. So all in all, of course, obviously, lower rates is much better for us in general. But we're heading in the right direction, and that's one of the most important things. Because if you have clients that are on the sideline that are saying, "I'm waiting for home prices to drop, I'm waiting for rates to come down," you know that those things do not happen together. Rates come down, home prices are going to go up. So, and we know that rates are coming down already on average. The peak was in August, September at 8%. Now we're already down about 1.5 points since then, to about an average of about 6.5. So we're already kind of seeing rates come down. Now it's that conversation with that client. It's like, hey, rates are already coming down. If they hit the fives, you're going to have a very difficult time purchasing a house. You're not going to be able to fight for credits like you are right now, things like that. And the difference in saving from let's say 5.875 to 6.5, maybe about, depending on the loan amount, obviously, maybe anywhere between $80 to $100 a month, right? But if we're assuming that that 5.8 is not going to come out till, let's say, March or April, and we're considering the fact that they may not get any sort of seller credits at that time, where right now we can get them, let's say, $7,000, $8,000, and we won't be able to get that for them in March, April once the market starts to pick back up. Then it's $100 or $8,000 up front, right? Which one is it that you're looking to save for the most part? And those are the conversations that we have to have with those clients. Do you guys have any questions at all for me? No questions today?
Hey, Mike.
Hey, thank you.
Oh, of course, someone is trying to call me at the same time. No real estate, no real questions, but I did want to say that I am receiving the emails about my clients getting contacted, and I appreciate that because it's really drumming, starting the conversation back up for them. In the sense of these rates coming down, how soon do you think that people are going to probably start jumping into the race, the rat race again? Like, when do you think we're going to start to see that again?
So one of the guys that I listen to all the time, and he's been right for the most part this year. He said, and he did this like in September or October, I believe. He said that he sees rates in the fives as early as the end of this year. He said this a couple months ago, but he said realistically the beginning of next year. So he was thinking January, February, because inflation is coming down pretty rapidly. So I can see that. I don't want to tell people that. I'd rather continue to say spring is going to be a safe bet for us. I think that, but he's saying that it could be January, February. That could be the earliest where we kind of see rates come in the fives. And you're going to see the people, especially in the South Florida market, that have been sidelined because of rates. They're going to jump back into it. And we're going to see a kind of an influx. It's not going to be 2020 or 2021 again, guys. It's just not going to be. But right now, where it's very, very difficult for us, right? We're kind of fighting for every single client. It's going to become just a little bit more lenient, where the work that you're doing right now, that is much, much harder than it was in 2020, 2021, can become a little bit more easier for you to be able to get that lead in and things like that. So it's not going to be the crazy things that we've seen in the past, but it is going to pick up a little bit to where, especially in the South Florida market specifically, where it has slowed down, but not like the rest of the country. And so you're gonna have multiple offer situations, even if it's 3 or 4, where before it was 10 or 12. You're gonna see that. And so if it's 3 or 4, asking for credits is not really going to be a beneficial thing. You can try, but it's just going to take you a much longer time to get under contract. And that's what we want to tell the clients.
Okay. And then also, Hometown Heroes, are we still in good standing with a lot of money in that pot?
Yeah, I'll tell you right now how much is in there. Let's see. But you guys actually, I'll share my screen for you guys on this one. So whenever you guys are curious about what the rate is on Hometown Heroes, how much money is left over, you go to ehousingplus.com. Okay. You're going to go to programs. You're going to go to home ownership programs. And then you're going to click on Florida. Florida housing is the first one. And you click that. Let's go to rate/offerings. Did they take off the thing here? So the rates for today on Hometown Heroes, we're at a 6% flat on FHA, USDA, VA. So look at that. And even on their conventional product, which is usually much, much higher, it's only about 6.375%. So these are the rates for the Hometown Heroes. They had a ticker up here. I don't know if they just if they removed it in total or if they just removed it for today, but it was literally right here. I saw it on Saturday. As of Saturday, there was about $61 million left. Okay. So they started off with 400 million. They're down to 61. That money is going to drip. It's not going to come off as quickly as the original money did, obviously, because when Hometown Heroes was hot, everyone was trying to jump into it. But it's still going to be gone. And I would give it till about the end of January, February-ish, maybe, once that money runs out. And then we'll kind of see if Florida is going to do that again in the future. But if they do, it may take about a year or so before that happens again.
Thanks, Mike.
No problem. Any other questions? Or scenarios, conversations that you had with a client that was pretty interesting that you would like to kind of inform, the other realtors that are in here, hey, this happened, this is how we overcame it, stuff like that. We always want to do that.
Hi, Mike. This is Tanya. How are you?
Good. And you, Tanya?
Good. I don't know if you recall, because you probably have talked with so many other buyers, but I had sent you a buyer to pre-qualify, and she keeps calling me back because she must have went online. I don't know where she got pre-qualified from with Bank of America.
Okay.
But they pre-qualified her for like 218,000. I think when I originally spoke with you, you were like, she was at like 140 with you.
Mm-hmm.
So where are these other lenders, like these Bank of Americas, pre-qualifying people? I mean, I'm absolutely not showing her anything with a pre-qualification from Bank of America,
Mm-hmm.
but where are they getting this? How are they approving customers and setting up these false approvals?
So that is tough because I don't, it's going to depend on the loan officer that does the work and how they do it, right? So for us, we don't give a pre-approval unless we actually check credit, income, and assets. But there are a lot of people in the industry, and a lot of them do work at banks because they have an influx of clients that come in, right? Those are people that they're not building relationships. They are basically, they get a lot of business through Bank of America, through Chase, through Wells Fargo, through these different avenues. And so they already have an influx of business coming in. And so to not waste time, they may do like a phone interview. Hey, what's credit? What's income? How much do you have? Okay, based off of what you told me, you may be able to get pre-approved for around this. I'll send you over the pre-qualification letter. That could be an option. It could honestly be that the team messed up on my end. Like, if you want, you can text me over that client, and I'll comb that application, and I'll tell you, no, it's 140 for this and this and this and this reason. It could be something that we made a mistake on, but for the most part, a lot of times it's just that they don't really run the application,
Right.
And they may not pull credit, and if they pull credit, they're not really doing the proper calculations and stuff like that. They may shortchange the insurance that we know is unrealistic and things like that.
Right. Got you. Okay. Thank you so much.
No problem. Any other questions? Scenarios, anything like that? Well, I do have the recording, Nikita. I know that you came in late. I'm going to say this one last time here, and then Nikita, I'll actually send you the recording today. But remember, if you are a NAREB member and you're interested in going to the gala, I'm giving away 4 free tickets today. Just email me as soon as we hang up here. Let me know that you're interested. The first 4 people that email me will be the ones that get the free tickets. Okay. Any questions that you have throughout the week, don't hesitate to reach out to us. We'll definitely help you. Tanya, if you can, text me over that client, and I'll look over the application today, and I'll let you know exactly how we got to the number that we did.
Okay. Thank you.
All right, perfect. Thank you all. Have a good one.
Thank you, Mike.